Hello friends, Namaste. My name is CA Pravesh and in this video I am going to discuss about return on investment ROI. ROI is a fundamental financial metrics or financial ratio which is used to measure the profitability of an investment. Return on investment expresses the profit or loss that is achieved from making an investment relative to its cost. This ratio is used to evaluate the performance of particular investment or performance of overall business. Now let's understand how we can calculate the return on investment. Return on investment can be calculated by using this simple formula, where in numerator you can see that we shall take the difference between the current value of our investment and the cost of that investment, and in the denominator we shall take the cost of our investment. Now let's do the analysis of ROI. ROI gives the profit or gain or loss from the investment. Therefore, higher the ROI, better is our investment. Whenever ROI is 0, we can say this is a break-even point. Friends, in order to understand this better, we shall dive in our mathematical calculation. So let's see how we can calculate the return on investment. I have taken 3 different scenarios. In case 1, we have invested in shares. In case 2, we have invested in bonds. And in case 3, we have invested in gold. So we have to see these facts or data in order to calculate the return on investment. So first thing that we have to see is date of our investment. The date of our investment is, in case of shares, it is 1st Jan 2017, and in case of bonds, it is 1st Jan 2019, whereas in case of gold, it is 1st Jan 2021. The cost of investment in each case is different. Shares we have purchased at rupees 10 lakh. I am not disclosing how many numbers of shares were there because that is not relevant for calculating ROI. And bonds, it is 5 lakh, and gold, it is 20 lakh rupees. Income from each investment, there can be some regular returns that we get from the investment. For example, if we invest in shares, we can get dividends on annual basis. If we invest in bonds, we'll get interest or coupons on annual basis or 6 monthly basis. And if we invest in gold, probably unless and until we don't rent that gold, we'll not get anything as regular return. So I'm taking these regular returns from the investment that were made in shares and bonds, but not in gold. And now, as today is 31st December 2022, let's assume that, and now the current market value of investment is 13 lakhs for shares and 5.5 lakhs for bonds and 22 lakhs for golds. So let's calculate the return on investment. As we can see, the detailed formula for return on investment is current market value of investment minus cost of investment. This is the capital gain that we achieve from the investment or capital loss, plus the regular income that we received throughout our holding period. So throughout our holding period, we have received the other income as well, like dividends and interest, and definitely that is because of our investment. That should also be considered while calculating the return on investment. So in return on investment, there are 2 parts. One is our regular income that we may receive while holding those investment, and another is capital gain or price appreciation in our investment. So both of these returns shall be taken together in order to calculate return on investment. So let's do this. In first case, our other income is 2 lakhs, and current market value is 13 lakhs, and our cost of investment is 10 lakhs. So 3 lakh is our capital gain and 2 lakh is our other regular income, divided by, we have made our investment at 10 lakh. So this is how much? 5 lakh is our total return, and we have made the investment of 10 lakh. So over the period of 5 years, we have made return of 50%. If we multiply this by 100, we will get the percentage. So 50% is our return in case of shares. Similarly, in case of bonds, we have earned other income of 1.5 lakh and our current market value is 5.5, and that's not right. This is 1.5, 5.5 minus 5 divided by 5. Okay. So what is our capital gain? Capital gain is 0.5 lakh. And what is our regular income? That is interest. That should be 1.5 lakh. Altogether, we have earned 2 lakhs throughout our holding period. So this is 2 lakh out of 5 lakhs. This should be 40%. So this is 2 lakh out of 5 lakh, and this should be 40% return. Similarly, in case of gold, there are no regular income, which is 0, and current value is 22 lakh, and we have purchased this at 20 lakh, and this is our cost of investment 20 lakh, and we have got this cost to 10%. My friend, what do you think? Which investment is better? You cannot directly say that the shares are better than bonds and bonds are better than gold as their ROI are higher, because there is one limitation in ROI, that is in calculating ROI we do not consider the period metric. We cannot say that shares are better than bonds and bonds are better than gold as their returns are higher than each other investment, because while calculating this return, one factor is missing, that is the period of holding. In case of shares, we have held the investment for 6 years, 2017, 18, 19, 20, 21 and 22. So the shares are held for 6 years. Okay. So in 6 years, we have gained the return of 50%. Whereas in case of bonds, we have held the investment for 2019 to 2022, that is 4 years. So this return is for 4 years, and in case of gold we have held the investment for 2 years, 2021 and 2022. So this is for 2 years. As you can see that the different investments have different holding period. We cannot directly judge the investment just by looking at the ROI from that investment. We can do the comparison if we calculate the average annual return from each investment. We can simply calculate the average annual return by dividing the overall return by period of holding. So we can see that the annual return from shares is 50% divided by 6, which is 8.33%. This is per annum. And in case of bond, this is 10% per annum, and in case of gold it is 10 by 2, 5% per annum. Now we can easily say that which investment is giving better return. As we can see, bonds are better. So now we can judge that out of these 3 portfolios, the best performing investment is bonds. Okay. So far we have understood the calculation part of return on investment. It is pretty simple. By using simple formula, we can calculate this one and judge which part of our investment is doing better and which one is not. Now friends, let's discuss about the advantages and disadvantages of using ROI. ROI is a universal metric. It is often used for comparing the investment, and that is good thing about ROI. And another advantage of using ROI is it is simple and easy to calculate. However, it has its own limitation. The disadvantage of using ROI is ROI ignores the risks factor that are involved in our investment, and another disadvantage is ROI ignores the time factor and the duration of our investment. So it does not directly give you the comparable parameters, as different investment might have different holding periods. One more thing, many of us might get confused with the return on asset with return on investment. They are different in a manner that return on asset is based on the company's performance or company's ability to use the assets to generate the profit, whereas return on investment is based on the return from the particular investment or return from the particular project. So these two things are different. One is focused on particular investment, another is focused on overall company's performance. Now last but not least, we would always recommend you, together with ROI, we can use other important financial metrics to make our best judgment. So this is the end of this video. Keep learning, keep watching, and have fun.